I'm going to make some strong statements here. More than 99% of tokens as investments are crap.
This podcast is for informational and entertainment purposes only and is not investment, legal, or financial advice. Opinions are those of the host and guests and do not reflect any affiliated entities. Investing involves risk, and past performance is not indicative of future results. The host and guests may hold positions in discussed securities. Now, please enjoy the show. Andrew, thank you so much for joining me today. Super excited to chat with you. All right, Andrew, you are the Chief Investment Officer at Black Lotus Capital. Black Lotus manages a long-short fundamental hedge fund focused on digital assets. I think your strategy is really notable because you guys have a strong focus on small and mid caps. And also you guys have a really interesting shorting strategy. Obviously, we'll dive into all that very shortly, but you also have an extensive background with hedge funds with over 15 years of experience. And you started your career at JP Morgan's emerging market desk. All right, Andrew, tell me about your journey pre-Black Lotus.
Yeah, so about 15, 20 years ago, started off at JP Morgan out of college. I was in the global emerging markets desk. This was 2008, just when the crisis was really kicking off, the great financial crisis. And I was working in fixed income, like the repo desk, derivatives, other things around those liquid markets, and doing margin calls on Lehman Brothers and stuff. At the time when everything was falling apart, it was a nice entry into the financial world, and I learned a lot in that experience. 3.5 years later, ended up going to get my, went to grad school, got my MBA, came out of school, always wanted to be on the buy side, with hedge funds and everything, wanted to get into equities, all that. So I ended up working with a few different hedge funds and spending almost a decade at a notable top tier hedge fund that was predominantly long short equities, but we looked at commodities, some macro stuff, all of it. And I primarily was doing research on different themes, different ideas. My focus was more heavily on the primary research side, where I get people on the phone who really understood the questions that we were trying to get answered. And we try to get an edge through that and better understand whether or not our theses are right or wrong. And then a lot of like innovation stuff, trying to, help improve the investment research processes, data stuff, things like that, tinkering, because the markets are always evolving and, we always want to do that as well. That eventually led us into the crypto world. I personally have been in crypto since 2017, playing with altcoins way back when, along with a lot of the team, and then started doing it professionally, just helping lead kind of the early stages of the build out at a hedge fund I was at, doing research and helping understand just the mechanics of the blockchain and how things work and everything. And this was around 2020, 2021, where 2021 everyone was paying a lot of attention to crypto. Personally did well enough where felt like if there was ever an opportunity to take a shot and kind of launch our own fund and do something differentiated in an asset class that I felt was very nascent, so lots of opportunity. Don't have to compete with the Warren Buffetts of the world in the equity space, who are well ahead of newcomers. Why wouldn't you take that shot? We only live once, so that was the kind of idea at the time. Also decided to move from New York City after being there for 15 years down here in Puerto Rico. Been here for the last 4 years, and then we launched Black Lotus Capital from there.
Amazing. Okay, so when you were during your hedge fund career, you were not sector focused, right? You were kind of looking at many different assets, categories, et cetera.
Yeah, we were generalists. So what we generally, and this is what Black Lotus tries to do as well, is you generally want to look for opportunities of differentiation or contrarian views, especially when like big shifts are happening. So when there's big changes with a company or a project or something, there's a lot of confusion, a lot of uncertainty. And many times, going back to the old worlds, like in TradFi, you have very specific sector analysts who've been looking at stuff the same way forever, right? So they feel like they understand how it's going to play out. But when big changes happens to companies and industries, sometimes it's interesting to take a different perspective at it and look at it from a different way. It's like, hey, I've seen something like this happen over here, totally different industry, totally different company, but the first principles of it are similar. And so that's, you have good, strong bull and bear debates on both sides. That uncertainty is opportunity, that complexity. We apply a pretty deep research process to understand that as well as we can. And hopefully that gives us a strong view or some conviction. And then we take that view and hope that the market over time eventually rewards us for that.
Can you give an example of like a large change that was happening in some, and you make it up, it doesn't have to be a real example, but during your hedge fund days, during your TradFi hedge fund days, give an example of a large change that was happening in something that you were looking at, because I'm just curious. And then can you apply the same kind of hypothetical to a crypto example?
It's a good question. I won't use any real examples just to keep those things proprietary. But, for example, I can make this kind of up off the top of my head. If I remember looking at grocery industries in different countries and comparing it to the grocery industry in the US, where it's very fragmented. In other countries, there's usually maybe 2 to 4 dominant players and everything. So consolidation, usually yields market power, economies of scale, all that stuff, and pricing power, right? Because in the end, like, these are very thin margin businesses. How can you get pricing power over your customers? It goes back to, Porter spy forces, buyer, supplier power, all that stuff. So let's say, you've seen that happen, and then, you see the US consolidate, right? Some big chain starts gobbling up everything. Next thing you know, they start to get market power over their suppliers of food products, commodities, whatever, so they can lower their cost. And they can keep the prices where they're at, or they can, because they own all these chains, they can even, potentially increase pricing. We saw a little bit of that example with the airline industry, which I know was hated by the equities markets for a long, long time. But, in the end, you're trying to build some sort of unfair advantage without, antitrust or monopoly kind of risk there. But that's, if you see that change happen over here in this industry, and then you see it over here in this industry, then the analysts in that industry may just be like, no, it's the same. It's the grocery industry or airline industry. It's going to play out the same way. The margins suck. But because we've seen that happen so many times in other industries, maybe it's going to be different this time. And if it is different this time, that's where you make the biggest, returns, because effectively the market prices re-rate, based on the market realizing that this is a different, kind of higher margin business. So that's an equity example. In crypto, man, it's far, far more complex than equities, commodities, any liquid asset class I've ever worked in. It's just much, much crazier because, yes, you have different sectors, you have different protocols, but these are all smart contracts, kind of algorithms on blockchains and stuff. You can program them to do whatever you want, and there's nothing that stops, even something like Bitcoin, which, hasn't done this, but Ethereum is a good example, right? Like, they have taken the route of evolving and, being able to obviously be more scalable, not stick to the kind of old way that Bitcoin just wants to be a stable store of value or more stable store of value, kind of compete with gold and stuff like that. But we've seen this in projects, where they could start off as a borrowing and lending DeFi project, and then next thing you know, they're offering, something else. I think Jupiter is a great example of this. They started off as kind of a DEX aggregator, centralized exchange aggregator. Then they started offering lending, borrowing and lending, and then now they're going to become a layer 1, and so on and so forth. And it's happening so fast. And, so the way we look at the crypto markets is they're all competing with each other. And, a lot of the capital that invests in these are, fast money rotating capital, and the narratives are shifting so fast. But can you look at this space and see, hey, I've seen this evolution over here, or these types of catalysts, and it's worked out for them. Could it work out for these guys who are trying to do the same thing? and they're carving out their differentiated value proposition in a way that, may be able to steal market share from, whoever they're trying to, enter into or vertically integrate into. So loose examples there, but that's, that's some of the ways we would think about some of the frameworks around it.
Very cool. Okay. So in 2017, you started dabbling in, or I guess, I don't know if you were dabbling or not. Maybe you went really deep in crypto, but 2017 was when you first started to dive deeper. And was that through your TradFi hedge fund activities, or was that just your PA? You're doing that on the side personally?
Oh, pure PA. I mean, we used to have like weekly meetings at my apartment in New York City, just talking about altcoins, trying to understand them. And it was exciting. Everything was going up crazy, and, things were moving fast, and, everything was promising the world, like, oh, it's going to disrupt this industry, cheaper, faster, safer than, the way these corporates are doing it and all that stuff. And, anyone who comes into this space, I feel like you kind of go through those phases where at the start, you're like, this is total gambling, look at the people who are recommending, buying this stuff, like it's usually the people that are, doing that kind of stuff. And then you start to understand it, and you're like, oh, there's Bitcoin. Okay, there's something there, right? It is differentiated for a store of value. It's something we've never seen before. Does that have value to people, for the use cases of store of value? And then you go down the rabbit hole, and you get into smart contract ecosystem, layer ones, all that stuff, and then all the sectors and all the things you can do that, gaming, all of it. And it's very easy to get seduced by the potential of what that all could be. And we were no different than anyone else getting into that. But, we tried to apply our traditional finance frameworks or experience into understanding these things. If you want to disrupt this industry, well, we know that industry. I spent a lot of time researching that industry. Is this truly better than what they're doing? Cheaper, faster, safer, is the product or the service that they're going to provide. Conceptually, can it get there? And that was a lot of how we started. And then obviously that became professional later on.
Yeah. So it's funny because, people will still argue today whether or not crypto has fundamentals, right? In 2017, like there was almost zero, like we can call it. And then I feel like in 2025, especially, I've been hearing revenue meta, which is like the new meta, which I love that. I love that, like, oh, it's the new meta's revenue, which is just hilarious. But so have you, from 2017 till now, have you seen this significant push or movement within crypto towards fundamentals? And did that also, inspire you even more for like Black Lotus and your thesis? Because, you're looking at these from a fundamental lens.
Crypto is very different from equities, given that, the market players and really most other asset classes, fixed income, commodities, you name it, there's much larger institutional players and players who take more of a longer term time horizons than just trading. So think of like mutual funds, pension funds, those types and everything. A lot of them are they're bigger. They're not trying to trade in and out. Liquidity is constrained, and they just want to make long-term investments. Crypto market generally, outside of Bitcoin and Ethereum, we were just talking about this, just before this. But Bitcoin and Ethereum is kind of crossing this chasm where institutional money is starting to flow in, and that's a little bit more sticky than the crypto native money that's generated. Generally, kind of driven crypto asset prices of the past. But the rest of the market, the thousands of other tokens, are still primarily driven by crypto native liquidity, which I consider quants. You can throw market makers as part of that, traders and retail. And most of these strategies, or the strategies that they employ, are very short-term oriented and almost schizophrenic when you look at the price action and just how fast everyone changes their mind and everything. So with fundamentals, if you look at like from the 2021 cycle, things got so ahead of themselves and overvalued by any kind of metric you look at it when you price it versus other asset classes. And so a lot of the kind of pain over the last 4 years, I think, in a lot of tokens that still aren't back to all-time highs, still down and everything, it's just kind of the market evening out over time. And so The other thing that I always caution is how do you define fundamentals? If you come from the Warren Buffett school or, equities and everything, fundamentals usually, people are talking about cash flows, right? Cash flows, profitability, all that stuff. But if you go into like commodities or other asset classes, what they think of as fundamentals may be more supply and demand related, marginal cost of production, things like that. So when we came into crypto and try to build frameworks for this based on our experience across all those liquid asset classes, like what's the fundamentals really driving the price? Like that's what I really care about in the end. Our job is to produce alpha and manage risk and everything. And if the market isn't really rewarding revenues and stuff, because most of these things don't produce enough revenues and most of them aren't profitable, then what are the fundamentals driving it? And that's where crypto gets so much more complex. For meme coins, it could be social activity, right? For DeFi protocols, they may not make enough money to buy back their tokens and kind of offset the dilution or inflation that's happening there. But their total value locked or volumes are spiking and they're taking market share from others. And you can see a little, sometimes a price correlation with the token to those metrics as those fundamentals go up. Sometimes it's the token design, right? The economics of it, where we get into inflation, dilution, all that stuff, because most of these tokens do that to try to bootstrap users into their ecosystems. And that, can drive prices, right? Venture capital unlocks, things like that. And so there's so many things you can look at, but the biggest thing is probably liquidity. And maybe you can consider this more market market metrics and things like that. But, network effects around liquidity, around the token, the ability for these big quants, big traders, big players to be able to actually run their strategies in a token seem to have one of the highest correlations with price. So we look at everything, and some are more leading indicators than others. A lot of these all drive up to the narratives that kind of make these big moves across sectors and tokens. Our job is to try to understand that and employ what we believe is the right framework for what's going to drive the token price, as opposed to just, sticking to the traditional fundamentals and just believing over time that, eventually it's going to play out. But to answer your question directly, I think in the past year is the first year where I think a lot of us have noticed that fundamentals that meta does seem to be playing a more of a role. Hyperliquid is the greatest example here. There are not many hyperliquids out there. There's plenty of protocols making good money now. It has evolved a lot since 2021. But when you weigh the revenues, versus the dilution of the token, and most of that has to go back to the token holders for it to be a good investment. You could be making plenty of money as a project, but if it's not being value captured by the token holders, then who cares? And so most tokens are still net dilutive when you compare emissions to buybacks. Hyperliquid has given an example of something that's growing that has become looking more sustainable these days than most other perpetual swap dexes in the past. There are other examples out there, but they're very few, far in between. I feel like I can name them on one hand, like BNB, Tron, and like Pancake Swap, like probably have been one of the few examples of more sustainable net deflationary, tokenomics, where yes, over time, if that continues, token price should go up because the supply of the token, the net supply, is going down instead of up like every other token. But it's good to see that Hyperliquid, and we saw Pump.Fund a little bit, with their buybacks and stuff, making a lot of money, starting to have more of a narrative effect. And we hope that that's the beginning and that continues over time, because in the end, profitability is what matters, because how else are you going to offset the supply and demand of the emissions of what drives the prices of these tokens over time?
Yeah, and also, you mentioned fundamentals don't have to be just cash flows necessarily. Like there's supply and demand is a great example of that. And, we've been seeing that over the past few years bleeding into TradFi, where it's like, there's meme stock like GameStop or like, I don't know, Palantir or Tesla, like they're not trading on metrics that like make fundamental sense, quote unquote. So and also, I guess building off of that, how important is the story that, and this is getting a little bit woo-woo, but how important is the story that these founders are selling the market in order to attract retail, and also not even retail, just other people that are maybe institutions that are buying that story. Because like, again, Tesla, great story with humanoids and everything like that, but their current, the amount of money they make today doesn't really justify their current valuation. So like, we're kind of seeing crypto and TradFi or equities kind of hand in hand a little bit in that sense.
Yeah. So the one thing with tech is it's made everything a lot more. The network effects have become much more fluid. So with GameStop and those things, that was kind of the first kind of big things people can remember where it started deviating from the cash flow fundamentals and everything and started running on something else. It's funny, equities started off, let's just call it fundamentals for lack of a better word, very fundamentally driven, and has become more meme-like and everything. Part of that is simply because social media has gotten way more efficient. We're all on social media talking to each other, looking to see what everyone else is interested in. It also builds a sense of community. It's like, oh, my friends are with this. We're going to ride this together. Kind of maybe replacing religion a little bit, right? Back in the day, you go to the church and that was your community. And that's where you would find that solace. Today, it's social media, and that's where your friends are at, and you find people that share similar values or things that you like. But yes, that has definitely exacerbated everything. And then when you tack on the tech efficiencies of high frequency trading, quantitative strategies, very short term oriented, fast moving stuff, that just pours gasoline on the fire. And so that's why you get these crazy moves where it's like everyone's moving all at once. All the money is moving all at once into something. And then, of course, it only lasts until, the next narrative, next theme goes in there. Crypto started off that way. And now it seems like it's trying to go in the equities direction. So maybe they're trying to meet in the middle. And hopefully we see that over time. But selling the story matters so much. I mean, we see this time and time again. And this is always out there, but price leads fundamentals a lot. Founders who have done a good job at creating those liquidity network effects to get listed on Binance or Coinbase or Robinhood or whatnot, these guys, these exchanges have access to all the buyers and sellers, right? If you're, not listed on there, you're automatically struggling as a token to even get buyers because they can't even buy your token, right? So, some of the best projects or most successful ones that got into the top 100 were very good at getting those listings. And the way to do that is generating volumes just from the crypto native money, trading it back and forth. Exchanges make money on trading volumes. So if you can generate that volume, and a lot of that is driven through the hype cycle and everything, it increases your chances of getting a listing. And then, if you get listed, you kind of go up another tier and re-rate to a higher level market cap or network effects around liquidity. So it is very important. We've seen this so many times where some of the projects we like the most, fundamentally, disrupting the real world, we think it's inevitable over the next 5-10 years that those are going to be your future Ubers or whatever, just built on a blockchain stuff. But they don't pay much attention to the token. And so great, you're building a good business and you're working through that. And these are all venture startups, right? So I get it. It takes time to get there. But if your users or customer base is at all tied to the token through emissions or something, and that token is just going down in price and angering everyone, it's going to affect the fundamentals of your business. And so I try to strive to founders that we talk to that, look, like that is a risk. Like you tied your economics, your fundamentals of your business to your token. If you don't, take care of that, it's going to hurt you on the other side. And if someone else, a competitor, does it better, everyone's going to move over there, right? Your customers, your users, and all that stuff. So it is very important to do that right. Obviously some of the ones in the top have been very scammy with it, overselling, overhyping. I certainly don't recommend that. But it is quite important for the token to get to that liquidity level where then it can kind of sustain the buyers and sellers and not just kind of have this constant, death spiral, a slow death over time in the token price, just because there's not enough buyers to offset the emissions.
When you were designing initial, or when you were ideating on Black Lotus and kind of the initial thesis and strategy, how did you come to the conclusion that, okay, we're going to do fundamentals, but small and mid caps? Because I would imagine that it would just be much harder to do that versus like, hey, we're going to do fundamentals, large cap.
Yeah, especially after this year where all these mid caps are lagging so hard, Bitcoin and Ethereum. Honestly, it wasn't like a specific like, oh, we're just going to focus on mid caps. Like we've owned and do own from time to time Bitcoin, Ethereum, Solana, the top 20 and stuff. We started off, our portfolio was more, top level concentrated than what it became over time. The reason why, it's just natural research, right? We've seen so many tokens, hundreds of these things over the years, and you're always looking for something new and something interesting. And so the research process just takes you down, further down the risk curve. If you look at fundamentals for a lot of the top 100, you can just make such a strong case that they're overvalued or there's not as much upside. If you believe that that's what's driving the price, there's not as much upside there. If anything, the risk reward is skewed to the downside for a lot of them. But again, that's not necessarily how crypto prices move. When you do research on these smaller tokens that have growing businesses, growing revenues, token has not been listed everywhere and it hasn't gone through that crazy parabolic move, it looks far more attractive from a risk reward standpoint. The problem is time horizon. Everyone always has strong opinions on it, but they usually fail to talk about what's your time horizon. If you're a long-term oriented investor, if you can hold stuff for years, then it's much easier to, focus on the fundamentals, whether it's, and if it leads to revenues or social network effects, whatever, it's easier to do that and just ride the volatility. But most hedge funds are not, we do not have locked up capital for 5 to 10 years. People get monthly statements. Bitcoin, it's a very volatile space. Bitcoin's doing this over here. You get compared to whatever benchmarks they're looking at. It's much harder for hedge funds or traders or anybody, anyone who's being judged, especially by an outside party and their peers, to be able to hold through and let those fundamentals play out. So we got into mid caps because at first fundamentals made a lot of sense. We believe in these things over time, but you have to adjust your time horizon to the realities of the market or you're not going to survive. And that's something that we've shifted over the past year, is to be a bit more nimble and consider that, hey man, like, you've got to perform, consistently, or more consistently. And then, the long term will play out as it does. And we have long-term positions at all times as well. But yes, the biggest winners down the road are going to be the mid caps, but most of them are going to be crap. So the few that make it, that actually prove it out and are able to cross that chasm, they'll be your future 10Xs, 100Xs, all that stuff. When, you don't know. But if you can be patient and let that play out, and this is what VCs are, able to do more easily than hedge funds, then great. But if you can't, then you need to focus a little bit, probably more in the top 100, more about liquidity, more about what drives the prices more in the short term, medium term. And that's just because liquidity network effects has such a huge impact on prices.
Can you talk to me about your research process? I assume you're diving deep into the team, the market, the potential revenue, and like maybe the token economics. But like, can you just walk me through your research process?
Yeah, it's always evolving, but basically, we started off very bottom up. Our goal was to identify the best, who we thought would be the winners in certain value propositions, right? Whether it's DeFi, borrowing and lending, or gaming or whatnot, areas where our frameworks told us from our experience in traditional finance and the corporate world that, hey, like this makes sense. And it all comes down to cheaper, faster, safer. Like if you think of technology or any disruptor, it's usually the new product or service is cheaper than the incumbent's product or service, or it's faster, or it's safer, and if it doesn't fit one of those first principle buckets, it's probably not going to disrupt. It's more of a gimmick, and most things are gimmicks, new innovations. And so, we started looking at it that way, and it's like, okay, the blockchain is, good over here. It can disrupt over here, but over here it sounds good. But, you need legal stuff to change, regulations to change for that to actually just, get disrupted. Insurance comes up all the time. That's the example I always use, right? Like real estate is another example. Like the things that drive people to purchase insurance and stuff is more forced on them or regulatory driven than it is like, I just want to have insurance just to have insurance. So we look at those sectors at a top level. We're like, okay, blockchain makes a lot of sense here, doesn't make sense over here. And then we look for the best ideas or who we think are going to be the long-term winners in those sectors or those value propositions. We go long those. And then, of course, on the other side, we short the ones that look like they have no chance, or they're losing market share or whatnot. And they're, nicely correlated with those. It's not one-for-one pair trading. Like, we're not for every DeFi long, we have a DeFi short. It's not necessarily like that because, look, I want to short some of these sectors that I think have no shot that I would never long anything in. We should have that as part of a diversified short portfolio. But that's the general strategy bottomed up. And in our view, there are a lot more things to research fundamentally, market-wise, tech-wise, all that stuff, making it much more complex and interesting than even a lot of the corporates that we used to, research back in the equities world. And yes, it makes it more complex, and the volatility makes it even more stressful with 24/7 trading. But to me, complexity is opportunity. If you can go in there and do it better and build better frameworks and have a better process, you can create a significant edge because I know how hard it is for everyone else to get to that point. And that's what we should be doing as hedge fund managers, right? If you want to have value, a differentiated edge, you need to be able to, to build something to give you that edge. And if it's easy, everyone else has already figured out, especially in this AI space. So you got to do things that are hard. So hopefully that helps a little bit. Yeah.
Have you gone through the research process and discovered multiple tokens and projects where the fundamentals are great and you're excited, but then you get to the tokenomics and the tokenomics are totally, I mean, you mentioned it earlier, like the company itself might be doing great. The product is great, lots of users, but they're just driving no revenue or there's no fundamentals flowing to the token holders. Is that like, how common is that?
I'm going to make some strong statements here. More than 99% of tokens as investments are crap. Most of these tokens are getting diluted to death over time. They'll never disrupt whatever they want to disrupt. They're already so far behind the first movers, and they're losing liquidity, right? No one's focusing on them. They're losing the socials, all that stuff. Doesn't even mean the projects are terrible. They still carve out their own little small business and everything. But tokens as investments, if your goal is for the token price to go up 99+%. And this is borne out in the data we looked at from 2017. We forget the names that were in the top 200 back then. Most of them are not even in the top 1,000 now. So shorting is a good strategy if you can hold through the volatility over time. But to get to your question, it happens all the time where the project is growing. It looks like they have a differentiated value proposition that users like. It looks promising over time. And you look at the token as an investment, and it's like tons of VC unlocks coming up. They're emitting the hell out of their token to generate the users, which is kind of fake, right? Because most of these users are mercenary. They come in to make quick yields, quick token emissions, and then they sell off. And maybe a fraction of them stick around. So that has been a constant problem for sure for most tokens. It's like, and that's why we've seen more fair launches over the past with hype and pump and these guys trying to do it differently, more public launches, not going the VC route per se as much. But I don't care how much money you're making or what your buybacks look like. If your emissions, whether it's through that inflation incentives or yields gimmicks or VC unlocks coming up, if that dwarfs the buybacks, and it doesn't look like the buybacks are going to grow enough to offset that over time, that's usually a good short, over time, long term. In the short term, other things move prices, but over the long term, these things are, generally supply and demand of buyers and sellers. And too much supply over demand leads to lower price over time.
Have you been successful in convincing any protocols/tokens or projects to that are in that scenario where they're doing well, they're making money from an equity standpoint, but none of the value is flowing to the token holders? And have you been successful in convincing them, hey, you should do this, and here's how I would structure it, blah blah blah? Or like that's part A. Part B is why do you think that these founders are not deciding, hey, we should send value back to the token holders? Like, are they like, hey, this is too good of a situation here, we're printing money, we have this token that's used like a user acquisition tool that we don't even like really need to send value back to, so let's just like not mess with it?
Yeah, the whole idea, and this is what got a lot of people from the equity world to pay more attention to crypto from a fundamental lens, is that one day they're going to make so much money, then they'll turn on the buybacks or the dividends or whatnot, right? It's just like a normal company if you think about it. Startups come out, they're loss making for the first 5-10 years even, right? They're just constantly raising more VC capital just to keep growing. Amazon, great example, right? And everyone's like, well, why don't you give money back? It's because the growth opportunity is so high. Like, I want to take that money and grow more and build a even stronger competitive moat over time. And then, when we get too big and we're just gushing, cash flows and we don't have anything else to, innovate or put that money into, then you give it back to the token holders. And it's just more pronounced in crypto because, again, these are all venture assets. They're not big public companies that have been around for 10 years. That's also why they're so volatile. If you think about it, like anyone who's done an angel investment, one day you're like, oh man, like when you make the investment, this is going to go to the moon. I'm going to make so much money. It's going to be a unicorn. 6 months later, you're like, oh, it's all over. It's gonna die. They can't manage their cash flows, all that stuff. And then 6 months later, it could go right back, right? So the volatility in crypto kind of reflects just the nature of venture assets and how hard it is to predict whether or not it's going to play out. For founders, we have spent a lot of time with them in investments that we own, more longer term stuff, giving them feedback. Another reason why that they don't like the best projects who've done really differentiated stuff and built really good community, user base, client base, whatever you want to call it, for their actual project fundamentals. They did that well because they fixated only on that. Like they had a traditional startup mentality. They just happened to be using blockchain to power it. And so because they have that mentality, just like a lot of successful unicorn, startup founders, they didn't care about the, what something was worth or, the value of the token or whatever at the start, because they're like, it doesn't matter, right? Amazon is the best example of this. Like, it doesn't matter right now. The stock price will be way higher down the road. Our goal is to create the things that would make that happen over time, and the cash flows will show up later. So we've seen a lot of that. Unfortunately, most of them don't take us too seriously in the first few conversations. They believe that if you build it this way, they will come because look at my revenue growth, look at what we're doing, look at the client list that we're getting on now. But at some point, if the token is lagging too much in the market or is just slowly dying, in price, their own clients and users will start to complain. Their own investors will start to complain. And it's really hard to ignore that if you start seeing that affect the fundamentals. Like, for example, if I'm a user of your product and part of me using it is getting token emissions back, to that I can monetize and turn into cash, that's my incentive to be an early adopter of it. But if those tokens are worth less and less and less over time, I might not want to stick around. It doesn't make any more sense. And so I'm going to stop doing whatever it is that was providing value to the network, and I'm going to go somewhere else. And the next thing you know, the fundamentals of that project are starting to die. So there's a symbiotic relationship there. Every founder needs to really understand this. Doesn't matter what sector you're in. DePIN is the one that stands out the most. I think some of the best things are going to come out of that space were real world examples of disruption with crypto technology is actually going to work and become profitable. But they're not there yet. And a lot of them haven't spent enough time on, doing good token economics to ensure at least some level of price stability in the token. And a lot of them haven't paid attention at all to the liquidity aspect of what drives token prices. And it goes in the other direction too. Price leads users a lot, right? So if a price is surging, it starts showing up in all the headlines, everyone starts paying attention to it. We start looking at it. It's like, oh, what's going on over here? What do they got? Ooh, that sounds cool. Oh, maybe I want to test the network out. Maybe I'll become a user, right? So it drives the fundamentals. So there's a reflexive wheel there. And so it's not only a mistake not to pay attention to the token economics in a way that drives value over time, because you could lose users, but you're also missing the opportunity cost of like, hey, if the price of the token went up, if it was more liquid, you could get a lot more clients and users into your ecosystem and driving that flywheel even more, which grows the revenues, grows the user base, all that stuff. So hopefully that helps answer the question a little bit.
That definitely. All right. So tell me about your shorting and hedging strategy, because I think that, when we last spoke, there, obviously you're long short. So there's the shorting aspect of just like kind of trying to drive value that way. But there's also there's a hedging aspect where you're trying to kind of dampen the volatility a bit. Could you talk to me more about both those sides?
Yeah. So everyone, when we started off, everyone told us shorting crypto, especially altcoins, is absolutely nuts. Everyone remembers 2021, and these things can go parabolic in a moment's notice and everything. But I spent a lot of time the short selling side in previous asset classes and everything. I'm type of guy that likes to tinker and test. Don't want to take anyone's word for it. For me to understand something, I have to do it myself and put my own money at risk, so I can feel what it feels like and learn. And even if I lose money, my own personal money, the lessons out of it can create innovation and differentiation, especially if everyone believes shorting tokens is just a terrible idea. So it started off that way. We made a lot of mistakes. You short things and it goes against you, and you're like, oh, they were right, But over time, you start to realize that there's ways to do this, because the first principle we believe in, that the data shows, is that over time, most tokens lose money or lose in price. For all the reasons we talked about before. So if that is like a really hard phenomenon, and that probably won't change unless, things can still go parabolic, altcoin seasons, all that stuff, but unless there's new money coming into the system that can offset the dilution, not only within each token, but then the launch of new competitor tokens every day with low barriers to entry, that's just diluting liquidity even more, then the token prices will go down. How do we make money from that? And that was the kind of thought. And so the problem was not so much over time that we thought we would be wrong about shorting tokens, but it would be that the volatility would be so immense in the short term that you just couldn't hold it through the pump and dumps. The simple answer was diversification. In the equities world, you usually do a lot of research on, certain companies that you're just like, oh, this earnings, they're probably going to blow it, or maybe they're a fraud or a fad or something like that. And then you try to time concentrated bets into it. Generally speaking, this is what short sellers do. Crypto land, you can't do that because there's too much price manipulation, too many pump and dumps, too many things that can just surge everything all at once, or surge things way abnormally versus relative to other tokens. So how do you be able to hold these shorts over time through that? You just keep them tiny. So most of our short portfolio is quite diversified. I won't tell you how many, but that has a few good things. One is it allows us to ride through some of the most extreme pump and dumps. We've probably been on the wrong side of a lot of those in the last few years. Hasn't really affected our performance, generally speaking, as long as you could hold it all the way through. It also lets us be a smaller piece of the open interest. If you're using perpetual swaps to short, if you're a big whale, everyone's targeting you, right? Let's squeeze this short seller right here. But if you're tiny, no one notices you. And so, people are like, how do you short these mid caps that are very illiquid? Oh, you just keep them small, and there's thousands of perpetual swaps you can choose to short, and again, we believe 99% of them are just going to lose money over time. So that's how we did that. But the other thing that gives us allows us to hold a more concentrated basket of longs that we think will be the winners over time, and effectively hedge the beta risk in the short term, medium term of when we have Q1 type moments and, sudden flash crashes like last Friday. Allows us, we're still a net long fund, so we'll still get, punched in the face a little bit, but it greatly reduces the volatility in the short term. So we can make this asset class or that whole crypto sector a bit more appealing to institutional money that just can't handle that kind of volatility of losing 80% of their money, in one cycle. So yeah, there's a lot of purposes that shorts serve outside of just alpha.
All right, so I want to talk a little bit about portfolio construction because, just from what we were speaking about, it sounds like you have a smallish number, more concentrated on the long side, and on the shorts, is it just pretty? Are there a lot more shorts by pure number, not by volume? But can you talk to me a little bit about your overall portfolio construction?
Yeah, that's correct. So, the good thing about diversification also is, you don't have to really monitor every individual short like 24/7 because they're so tiny. I mean, if you think about what the short basket is, it's just a diversified basket of crap. And over time, that basket just underperforms Bitcoin. It underperforms most of the market. And it's very simple, right? I mean, they're just diluting to death. They have no socials. They have nothing really going for them on the token side. Some of them will pump and dump, whatever, but they always kind of end up with lower lows after the pump. You don't have to monitor that too much. It's actually, the shorting is the easier part, and that's probably surprising to most people. The harder part is the long side because if you're more concentrated and that thing that you did a 40-page research report on that you love, that has great catalysts and all these fundamentals and liquidity all kind of inching in the right direction. If it's just not the flavor of the month or flavor of the quarter, and liquidity that's very short-term oriented is sloshing to something else, the difference in alpha can be immense. And especially if you're concentrated in it, it's a huge opportunity cost, and we're judged by that as a hedge fund. So execution is extremely hard. Anyone who's spent enough time in this space can do good research. The problem we found, even with ourselves, over this, past year that's been much tougher, is that it's so easy to be myopic in your research, your views, your bias, everything, right? Because you're so fixated on these tokens over here, you understand them very well, you talk to the founders, you know what they're doing. But it doesn't mean that the market is going to reward those things. And it doesn't mean that they're going to be able to execute on time or execute successfully. And a lot of times, even if they do execute successfully, as I said before, the market doesn't reward it because they're focused over here. They don't care about the fundamentals at that point in time. And so, I think to be able to do this job better, to execute better, I think being a little bit more diversified on the long side is helpful. But yes, understand what you're doing. Make sure that if the market were to keel over, if these tokens were to drop in 50%, that you're okay holding it through, because the fundamentals are eventually you believe that those cash flows, for example, are going to eclipse the token emissions. And that's where we all want to see most of these things end up if it's a fundamentally driven token by cash flows. If it's social metrics, it's the same thing. Right, it's like the socials look strong, they keep growing, they're taking market share from these other ones. Go find the shorts that offset that to help hedge it. But the concentrated positions need to be far more researched, but they need to be researched in the context of everything, and that's what makes this job so hard. Because there's not very many long-term holders, and the stuff that people like, the hedge funds that are more longer-term oriented, they already own it. Right? So who's the marginal buyer? We're all relying on quants, traders, and retail to be the marginal buyer. And so if that's what I got to rely on until institutional money comes in or until new money comes into the space or drives it, I need to understand that what are they focused on and why are they moving into these tokens versus the other tokens? And that's where we spent a lot of time over the past year we call them price drivers. It's like, what are these leading indicators, these metrics that we consider fundamental, that move the traders, the retail, the quants over here, or more probabilistically going to do it. And that's been a bigger shift of us in the last, I'd say year versus, in the past, where it's easy to come from TradFi and be too long-term oriented, too fundamentally driven. And then, you just lag too much. And lagging in this market with this kind of volatility can equal death for a hedge fund.
And just as like a quick frame of reference, what would you consider long-term in TradFi or what is considered long-term in TradFi, I should say? And then what would you consider long-term in crypto?
Yeah, I mean, long-term in TradFi, like as far as time horizon?
Yeah, like a month, 6 months, a year, like.
Yeah, long-term in TradFi, like, for equities, for example, we're talking years, obviously. Value investors will talk, 10 years, indefinite, right? So it depends on who you talk to. Commodities, long-term could be one cycle. So it could be as short as 6 months to maybe, a couple of years. Crypto, oh man, long-term, when I say long-term, I'm like, generally in the past, we would say, years, 3 to 5 years. Because that's how long we think it takes for these venture, projects to produce cash flows in a way that can offset the emissions. Long-term in crypto should be defined as, it should be less than a year, because every year in crypto is like dog years. When I say short-term in crypto, I think, day traders, less than a week. When I think medium-term in crypto, I think, maybe a month to a quarter. And then, anything past that, you can maybe consider long-term. This is how I have shifted how I define it over time. I'm sure others define it totally differently. But crypto has been one of those things that you just have to use your experience and be open-minded enough to adjust, your frameworks to the realities of what the market is, not what you want it to be or think it should be. Because if you don't, crypto is going to teach you a lesson.
Okay, so actually building up that point, like you said, what the market is and the reality of the situation versus what you'd like it to be. If you were an all-powerful god and you could say, hey, all the startups and companies and protocols in this space have to design their tokenomics in a way that does, most value accretive to the investors, what are the kind of the pieces that you would want to be in place for you to feel super comfortable that, okay, great, now the investors that are taking this risk and holding these tokens are getting fairly compensated for that risk?
Yeah, for sure, any sort of value capture is great. I understand, and I also understand it from a project founder's viewpoint that, they make these deals with big VCs because they need the money. Like how you got to raise money, you got to launch your project. VCs bring other, value as well, right? Brand value, if they're one of the top brands. People can't help but fixate. It's like, oh, they're backed by them. They're smart. It must lead to something good. So I understand the constraints there. In an ideal world, the tokens for us to invest, early on when, after the token generation event where it becomes, liquid and everything, we can trade it. Obviously we don't want to see huge cliffs unlocks, right off the bat. If that dwarfs the buybacks or whatever, it doesn't matter, right? It's only a matter of time. Most VCs dump. Most people, investors, 90+% of them that I talk to all the time, it's like auto dumping. They don't even think about it. It's a framework of theirs, like they don't care how good the project's working or looking. They're already up 5-10x, take your profits. And I understand their viewpoint as well. So as liquid managers competing with all of them, we have to think differently and assess that risk. So longer term, you can hold them into those, to the lockup period and everything, the better. When the unlocks happen, it's small, it's manageable, it's not going to tank the price or cause all this FUD. So try not to do crazy cliffs, in the short term. If you have investors that are forcing you to do that, I would question to see if there's a better way. If there's, others that would be a little bit more long-term oriented partners, they'll all tell you that they support projects and all that stuff. I think the market knows now that generally speaking, most of them are extracting and trying to get, their quick 5-10x's. So be mindful of that. And then on the revenue basis, the value capture basis, I don't expect that much at the start of TGE or early on in the project. We do want to see the fundamentals grow. Whatever you expect to be driving the token price, if it's a meme coin, if it's, it'll be socials, if it's a DeFi product, it's probably revenues or user growth or volumes or something like that. Whatever your metric is, be laser focused on it and, try to build it sustainably. So if you're going to use token gimmicks and all that stuff, I get it. It makes sense. It's worked out for a lot of projects because once you get those network effects, or the listings on exchanges, you do have another, sustainable level in token price than before. But if your gimmicks are so short-term oriented and you've seen it a million times and it's just all going to be dumped by mercenary capital because there's no reason for them to stick around past that. There's nothing really differentiated enough about the product. Then I would rethink the whole thing, and maybe not go that route or rethink your product really. So it's a combination. If you care about your token price at all, it's just supply and demand. Who the hell is going to buy your token? Why are they going to hold it? If you can't answer that clearly to me or to yourself, I would rethink it and talk to projects that have done this successfully. Talk to hedge funds or VCs that have, had successful, frameworks or whatever that's helped with that. But that's really it. That's all prices are in every liquid asset classes. It's just supply and demand of investors, buyers, and sellers.
How do you think about exit for your positions? Like when you're entering a position, especially on the long side, do you have a pre-built-in exit number that you have in mind, or is it more conditional based on the market?
Yeah, I've seen managers do this differently. Some have pre-set levels. It's like if token goes up X amount, either absolute or relative to the market, they take X amount of profits, whatever. We don't necessarily have something like that. It varies case by case. Exiting is the hardest thing. Plenty of times we've had things go up a lot. And, it's like, okay, do we take profits or is this going to go up another multiple or two, right? Because that's how you get your real big winners, right? And you get one of those a year. I mean, you can make your whole entire career with it. As we've seen in the past year, that nobody's holding past certain points for most tokens, and it's been a very fast-oriented traders market where people are taking profits faster than we've ever seen. I think the last time we've seen some better sustainable movements and pumps is Q4 2023, Q1 2024. A little bit of an all season there. It wasn't like 2021, but that was when we were performing the best. You can hold these things longer. Ever since Trump got elected, I swear, it's like everyone's erratic. It's uncertainty. Everyone's taking profits so quickly because they're so scared that the market makers are going to liquidate their token or the dump is going to happen faster. For us, it depends case by case. So if something is being fundamentally driven by a clear price driver that's correlated, a metric that's correlated with the token price, maybe it's revenues, maybe it's something else, and our research tells us that that's going to continue. That if anything, it's getting started, then you probably want to hold, let that thing compound, because the TVL or whatever thing is driving it, social metrics, it looks like it has a lot more room to run, right? We'll compare and contrast those metrics versus other token competitors' metrics on seeing where they're at and seeing how far that can go. That's where the research comes in, and that's where you can really get an edge if you do that right. Doesn't mean the price is necessarily going to continue to follow it, but the probabilities are better. If it's something that's totally speculative, it's a narrative shift. It's there's not really much movement on the fundamentals. We know it's market manipulation. Insiders doing some weird stuff. Just trying to cause a pump so they can get out of the tokens later on at a higher price. Then probably you want to take profits. And good projects go through that as well. So if we think it's more speculatively driven, or we think the fundamentals driving the price are not sustainable, then we should take significant profits. Again, easier said than done. And we should put that money in some other long. But if it is sustainable or we think whatever is driving it is going to last for a bit, then it doesn't matter if it's up 3x or up 20%. If we think it's going to continue, like crypto can get far sillier in the short term than anyone could ever imagine. I just want to own the highest probability stuff.
What kind of infrastructure do you need, or did you need to build, or do you need to have in order to operate Black Lotus to like its fullest capabilities?
Operationally, there's a lot of stuff. I'll save everyone the time and boringness around that. But accounting is hard. Generally speaking, especially if you're touching so many different things, and these things are volatile. And I think the service providers have gotten better over time in helping understand the mess, DeFi, staking, all that stuff. How do you account for it? You need to be able to access liquidity. So we know certain funds in certain jurisdictions can't use certain exchanges or can't use certain service providers. So what can you use? Can you construct your infrastructure to be able to do that? Portfolio management software is so important, and we've tried out different ones. We built some stuff internally, but being able to manage all the complexity and volatility, to really understand the true kind of beta adjusted risks of your portfolio and positions, I think is an extremely helpful thing. There's no Bloomberg in this space. We lack the stuff that we had in the other asset classes, the traditional asset classes. And I think that's a huge opportunity, for someone to do that far better. But that's from an operational standpoint. From an investment, management standpoint, research, portfolio management, decision-making, timing, sizing, those things, trade execution, it varies for different funds. We're not a high volume strategy. We're not trading in and out of stuff, I'm not trying to go crazy with that. We're generally, we want to let things play out and then make our best judgments and kind of not be competing in the shortest time horizons where most of the market is competing in. Getting an edge in time horizon, I think, is an opportunity for longer term oriented people, because it's almost impossible to compete with quants on the short term. Being able to research at scale, this is something we've struggled with as well. So just being completely blunt here, that whole myopic problem, like which ideas do we focus on? Can we filter through all the noise and ideas and metrics better? So we're just fixated on like high probability signal rather than all this stuff that's so distracting. That's really hard for humans to do. So, I haven't mentioned this yet, but people know this because I've been talking about it with friends and stuff. We think AI is going to disrupt our jobs. It's inevitable. The things that we've been able to do with AI for the investment research process, I'm talking building 40-page research reports. I'm talking analyze thousands of tokens in real time for longer term oriented positioning. I'm not talking about day trading or extracting arbitrage or anything like that. It's just night and day, and it's already good enough. If you can take that, further, it's impossible for me to research 1,000 tokens at once. I think any discretionary manager that's not moving in that direction, I'm not saying in the next couple of years, but over time, you will lose out to other funds who are doing that. And that can create an extremely big competitive edge for the discretionary management side. We're trying to build that infrastructure now. This is to solve my problems, of constantly being torn left and right and trying to keep up with all the craziness going on. But I think that's for investment managers, especially with similar processes to us, that is going to be the thing that I think all of us are going to have if we want to, keep producing alpha and maintaining an edge over the rest of the market.
These AI tools, is it like OpenAI and Perplexity and whatnot, or are these like custom AI tools that you're creating in-house?
It's got to be custom. Everyone's using AI for something, right? Trading bots, that's already been done. Quant strategies using it, it's already been done. How you use it is where you can create an edge there, and that can shift over time. And the most sophisticated ones are constantly evolving that in those worlds. But for longer term investing, let's say, medium to longer term time horizons, this gets into more of the research process, especially fundamental research. You can make that process 95 to 99% better. When I say better, I mean saves me 95 to 99% of my time, removes a lot of my biases or the stuff that can cause me to be schizophrenic as I'm looking for ideas or trying to fixate on what I should be focusing on. And it could do it far more unbiased and better at scale. Again, to know if something is a good investment, you have to know what it's competing with, the token and the project, right? The token is competing with every other token for the same amount of buyers, that are sloshing around. So even if they're different sectors, these sectors rotate. So how do I keep up with that and research this token and all of its metrics versus all the other tokens that it's competing with and all of their metrics at scale? The only way is through really advanced data analytics, customized AI, all that stuff. That's where experience comes in, because it's so easy to also do that and have garbage in, garbage out. A lot of data is wrong. A lot of data is missing. It's not uniform. We spent time putting our frameworks and trying to train AI to effectively replace us, to go do the research for us. And yeah, a lot of it's wrong and stuff, but shockingly, the stuff that works and looks good is really accurate. And so that saves us a lot of time and allows us to do things that AI can't necessarily do as much, which is getting on calls with founders and, curating the data, making sure the data is accurate and everything like that. Like, we do that anyways. So if I could spend more time on that side and then take that and fix the data over here in the AI to make it even more proprietary, well, then that's what creates an edge over time for our kind of investment research process. And it'll tell you the best times probability-wise, when to take profits on something, because it's like a, kind of a weather forecasting thing. It sees everything. It's like, probabilities are no longer as good for this one versus these over here. And you could set those based on the probabilities over longer-term time horizons or shorter-term time horizons. It doesn't matter. I think that's the tool of the future for discretionary managers. And I think crypto is just the easiest to exploit the inefficiencies from the volatility and the lack of sophisticated longer-term players. Equities, it's going to happen for them too. And I'm sure some of the smartest funds have already been going down that route and trying to figure out how to use AI for their processes to make it optimized and better, so they can maintain their edge or create more of an edge over their competitors for the time horizons that they're investing in.
All right, switching gears here a little bit, I want to talk about the market performance of crypto compared to like equities and gold, and because we're seeing like gold is going crazy, it's ripping, equities are doing extremely well, real estate is still strong in different markets. It depends on where, maybe not in Florida or Texas, but there's a lot of strong markets there. So do you attribute like crypto's underperformance relative to everything else? It still performed pretty well, but relative to everything else, is that just because like it's not as sexy and kind of the attention flows aren't there, or is there some other thing you're kind of thinking about?
Yeah, there's probably a lot of different variables affecting it, but look, you're totally right. You have gold at all-time highs. You have equities near all-time highs. Historic levels. You have global liquidity, money printing, easing of monetary policy and all that stuff, all going in the right direction. And the asset classes like gold and equities reflect that. So what the hell is going on with crypto? And it's felt like this ever since Trump got elected. We have noticed that difference. It's hard to say whether that's just a short-term lag and we're about to have a huge Q4 catch-up, or if there's something structurally that's changed in the markets. For Bitcoin, yes, it's up this year, but it's not up that much, right? Relatively speaking to what gold and equities and all these other assets, like Bitcoin should be above 150, marching to 200K if you're going to do that kind of analysis. So crypto, generally speaking, has lagged. There's a few things affecting it. So one, on a broad basis, look, Bitcoin whales have been selling. There's people playing the 4-year cycles. That's very obvious, right? I mean, how many wallets have woken up from the 10 years ago and just like, oh, we're going to start selling now? There's probably a lot of reasons why they're doing it. Some people are playing the 4-year cycles. Some people had just hit, hey, we're above 100K Bitcoin. It's time to, cash out. Some of them probably don't like the institutions, BlackRock, taking control of this market. And they're like, well, I was decentralized. I'm anti-government. So, it's no longer this. So I'm going to move my money somewhere else. Where? I don't know. That's more decentralized. I don't know. But we've seen that. If Bitcoin is soft, all coins are soft. That's obvious. The correlation has always been tight there, generally speaking. For the other reasons is, we had a strong dip in Q1 and then a nice recovery in Q2, Q3, but it was really only Bitcoin and ETH and maybe Solana to a lesser extent. But the rest of the market has lagged. Look, we've seen it every month in our own performance. Up double digits halfway through the months. You feel like this is where it's going to start to rocket off again. Crypto is very like misery for like months at a time, and it's like that once or twice a year. It just happens all of a sudden. It catches everyone off guard. You can't miss those moments because that is what we're all here for. But yeah, it's miserable in those times. So we had a lot of fake outs in the last few months. Even October started off very good, and then we had a flash crash. People are taking short-term profits much faster. What I keep hearing from the short-term oriented players that are doing this, outside of market makers who chase liquidation levels, for especially retail and traders, but people are afraid that equities are so high, gold's so high, what's wrong with crypto? Liquidity's so thin, it's dead. Hear this every single time, like it's like clockwork. When people are max bearish, especially the short-term oriented money, the emotional types, they won't say that they're emotional, but they are. That's probably a good sign because that means they're generally not long the market. They're not participating. Everything is dead. That's when you can get those big moves, and it takes very little liquidity when order books are this thin to get big jumps in price. You don't need everyone buying tokens. The quants will move the markets themselves, So that probably helps explain the short-term phenomenons of the fast profit taking. We will see how Q4 plays out. Seasonality is probably another thing. Sell in May, go away. We know those months historically have been bad for crypto. If anything, we were kind of flat, over those months. So maybe that's a good thing for Q4. I don't know. But as long as the governments keep printing money, governments keep lowering interest rates, if gold and equities can hold themselves and keep going up based on liquidity, the odds of a strong gap up in crypto is good in our opinion, even if you don't know when it's going to happen. Obviously, if something structurally changes with those asset classes or liquidity or interest rates or something, all bets are off. We could be going into a bear market. So only time will tell.
Awesome. Okay. We are unfortunately running close on time here, but I want to jump into some quick rapid fire questions.
Sure.
All right. What is your 3-year Bitcoin price target?
I hate giving price targets because they're always wrong. 3 years. I don't believe in the 4-year cycles anymore because of the ETFs and institutional adoption. I don't know. 3 years, 250 to 500 maybe.
Oh, 250 to 500. That's great.
Yeah, I'm saying it could touch in that range and then drop 50%. But if we're going to go about the way governments are going with money printing and easing and all that stuff, forget all the short-term noise that we're all paying attention to tickers and stuff. Like 3 years. Oh man, like if they're going to keep printing money like this and the debt is only getting harder to manage, this is the only way out. Yeah, why wouldn't Bitcoin be worth higher versus the dollar? Gold is already trying to do it. Probably catch up to gold soon. I don't know. So yeah, 250 or above. You could be at 150 to 200 before the end of the year. I'm not saying it's going to happen, but liquidity is what drives markets. Like it's monetary debasement. That money has to go somewhere. Where else are you going to put it in? There's only so much real estate you can buy, and people like to hold liquid assets.
Awesome. All right. What is the best advice you've ever received?
Be intellectually humble. Understand that we are all biased creatures. We're wrong all the time. Some of the hardest lessons, the biggest mistakes and stuff lead to some of the biggest turnarounds, advancements, creates edges, innovations, all that stuff. Nothing is ever as bad as it seems. Try to zoom out, but be humble. Whatever you're sure about, don't be too sure, especially in these types of markets. When I've seen hedge funds blow up or not make it, usually they're too sure about a certain position or leverage. They're betting hard, in a way that if it doesn't go their way, it can blow them up. We've made mistakes in the past as well, where we're too big in something that we believed in too much. But stay humble, don't discount anyone just because they disagree with you. Always look at yourself and ask yourself, how can I be doing this better? What am I doing wrong? What am I missing? Where my blind spots are? Yeah.
Love that. All right. What is your most contrarian take on the crypto space right now?
Contrarian take. God, I'm not saying this is going to happen, but, could we have another even short-term altcoin season? Not for every token, but, generally speaking, where tokens go up 50, 100%, ever. It's like people think altcoins are totally dead. It'll never move up again. We don't see that in the data or anything. So I think the contrarian take is that, yes, if you see a broad-based rally where everything's going up double digits or more over the span of weeks or months, don't be shocked. The same crypto native liquidity that's pumped these things in the past is always there. They're just playing around in the large caps these days, but they'll shift if they feel like there's more money to be made elsewhere.
Love it. All right, last one. What's your favorite book?
Man's Search for Meaning is my favorite book. I've ranked all the books based on categories. Purpose in life, all that stuff, first principles. A lot of the reason why I like that book so much is not only was it extremely fascinating about the Holocaust thing, where the guy survived concentration camps and everything, but he was like a psychologist. Like, he analyzed his own thinking and the thinking of prisoners and who survived, who didn't, all that stuff. And I found it so interesting, that whole how do you endure such misery, especially in these markets or what's going on in your life or whatever, so you can come out on the other side? Because building great stuff is hard, and everyone gets punched in the face over and over and over. How do I make it past that and learn from it? And that book kind of helped me. I mean, if he can live through that and kind of reframe his perspective on what that suffering was and how there could be a silver lining in it for how he lives his life going forward, well, then of course I can reframe being down in the markets and positions and whatever, and say, hey, zoom out, live to fight another day. If anything, you learn something from this, and and you can be better. Don't need to kill yourself or do anything crazy stuff when things aren't going your way in life. So that whole mental stoicism kind of mentality, you need to have that if you're doing any type of startup, or you're playing around in anything that's volatile. Because otherwise, if you can't do that, then it's probably just better to go get a corporate job and build nice savings over time.
Amazing. Andrew, thank you so much. This has been awesome. Where can people connect with you and learn more about Black Lotus Capital?
Yeah, I don't do Twitter. I think it's a waste of time to get in Twitter fights. I should be doing my job, which is research and managing the portfolio. But you can reach out to me, over email. It's probably best, andrew@blacklotuscap.com. And LinkedIn, it's good. I come from TradFi, so I have a LinkedIn. You can message me anytime there. That should be good enough.
Amazing. Thank you, sir.
All right. Thank you so much. Enjoyed the call.